The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, it's time now to take a look at what's going on in these markets here today. A bit of a recovery in the grain and oilseed trade. That was a welcome sight. We're going to talk about all that and more. Joining us here today on Market Talk, pleased to have with us Mike Zuzolo with Global Commodity Analytics, joining us from his office in Kansas as we're broadcasting in South Dakota. So we're almost in the same part of the world here today. Mike, thanks for joining us again this week. How are you, my friend?
Just a state away.
just a state or two away, I guess. Yeah. You know, if you really want to think about it. But hey, thanks for joining us here on Wednesday. Hey, we had a market recovery. That was nice to see in grains. I know it's been a rough one to watch here, but overall, a nice bounce in corn, soybeans, especially. Wheat ended up a little more mixed, but overall, the volatility let up some, and we got a nice bounce on Wednesday, Mike.
Yeah, and it was really necessary. I mean, I really think we're hitting close to opening a Pandora's box of a financial crisis type situation happening, Jesse. I'll go on record and say I don't think we should be at these price levels to begin with when you look at the supply-demand fundamental side of the equation, especially after the WASDE report. Our world wheat stocks are still running 7 to 8 year lows. Our world wheat stocks to use ratios are still running 9-year lows, even with the Russian crop getting bigger on USDA's update. Canada's crop got much smaller, but the trade has yet to really factor that in at all, nor do they really care about what's happening with the spring wheat possibility of a much lower yield. I think what we saw on the Wednesday trade, weather came in, beans led the market higher. That's going to be, I think, a footprint of what we'll want to watch for here the next week to 10 days as this hot, dry ridge looks to reassert itself. We look like in Northeast Kansas, anywhere from Northeast Kansas to Omaha, looks like to be the epicenter of the ridging. I think that's where the beans can play the best role in this market and give us the biggest lift. I also think that, we got away from the crop conditions report that didn't give us any kind of support at all on Monday afternoon and went back to that hot, dry ridging. The other thing, too, is the new bombings in Ukraine that we've seen 2 nights in a row against the grain infrastructure once again by Russia has gotten hardly any play. I think that maybe did finally get into the market today for a change. But I go back to this geopolitical risk premium or the lack thereof. It's really not about Russia bombing. It's about Russia's currency going down so low that the trade continues to sell the wheat in the United States especially. So my take is pretty simple at this point. No changes from what I look at analytically. We've got a macro-led break to the downside. This market move this week before Wednesday reaffirmed my mindset that it's about the Chinese currency nearing an all-time low in the offshore market against the U.S. dollar. It's about the Argentine currency helping push the Brazilian currency lower, and it's about the Russian ruble pushing the wheat exports out the door more for Russia in the market's mindset.
Well, a lot of great thoughts there, Mike. And you mentioned the Chinese currency, the Russian ruble, a lot of economic things we're watching. The dollar's been coming back a little bit here. I want to pull up a chart for us on the video feed and talk to us about looking at this 2-year Treasury yields versus the Bloomberg Commodity Index. And I know we're going to look at the commodity index here in a second, but walk us through what you're seeing here. What's the correlations you're seeing right now?
When you do your own analysis, Jesse, it's even more important to know or realize when you're wrong than it is to be when you're right. And so coming out of the WASDE report, having hit the yield numbers almost on the dime with the soybeans and catching the trend lower in the corn, and I think against most market participants. I really want to keep track of what's happening in these markets. And I hear what everybody else hears about a bigger Ukrainian crop or a bigger Russian crop when it comes to wheat. But we're not talking about a lot of increase, in my opinion. And so this is one of those charts that really keeps me on the straight and narrow. This is a 3-month correlation or relationship between the 2-year U.S. Treasury yield and the Bloomberg grain sub-commodity index. So it's only the grains. And what we see on a 3-month running basis is that we are almost at a negative 100% or a negative 1.0. We're deep in negative 0.9. So we're almost 1-to-1 negativity with these two market assets, different class of assets, but it just shows the power of the currencies and the power of the U.S. bond yields. And this is that great big sucking sound we hear coming out of the commodity investment overall, especially in agriculture, when we see those bond yields continue to go higher. And the biggest factor to me at this point, when I have to look at Russia, Argentina, and China, say those top three, what's number one? It continues to be China. If we could see China change their policy and stimulate their economy to where the market believes that the worst is over, I think we would see a very quick relationship change, and we'd see the dollar go down and the 2-year Treasury yields go down, and that would then bring this Bloomberg grain commodity index back up. But the Institute of International Finance just came out with a fresh report and said $3.7 billion US dollars pulled out of China the first 14 days of August. That was second only to October of last year when they put in the zero COVID policy. So we're seeing money run, and we are seeing that great big sucking sound. And that to me is what's really at the heart of this market.
Well, and as well, you mentioned that with the Bloomberg Commodity Index, the monthly chart, we'll share this on the video screen as well. And this, I think, just helps illustrate your points there that I like the term, that sucking sound we see of that money coming out of our commodity markets right now, Mike.
Yeah, and so we are now deep into the wedge formation. We are now at the apex, if not going below it. We're actually testing that long-term support line that's drawn off that low from 2020, where the number 5 is. And that's why I have that arrow there. And that arrow is also depicting the next key support level at around 40 in that index. And that's right in that same place where we were able to go into more of a sideways trading band from late 2020 to early 2022. And I think that's what I'm most fearful of, as far as when I talk about a Pandora's box maybe being opened here. The wheat may be showing us that the world economy is getting very dangerously close, with all of these countries having such severe currency problems. In China, the most important among them, we may be getting very close to another 2008 type scenario. And so my indicators are flashing red. I said a minute ago we should have never gotten here, that this is about the macro, but the macro side could get bad enough that we need to get hedges and floors in place. So that's what I've been talking about with clients this week, is if we would take out some critical support levels in the corn, especially because it's so close to it and it's following the wheat so closely still. Even with this weather, I'd still go after some bought puts just to protect myself.
Yeah, and you mentioned some of those support levels in corn and beans, and I know specifically at D's Corn, 481 was the one that folks were watching Tuesday. Wednesday, we finished essentially right at it. So I'm worried with you, with all the macro pressures and the outside market pressures and the economic woes that we're talking about. I'm worried about if we can't hold some of these support levels, what does the downside look like? What are our downside targets here in, D's 23 corn, Nov 23 beans, et cetera, Mike? It's a scary thought to think what some of the downside pressure and risk could be with these markets, just the way everything's acting right now.
Yeah, it really is. The best indications I have right now, Jesse, is another 4 to 10% down would be my guess. Based upon some of the leading indicators I look at, once you break through some key support levels for the wrong reasons, for some big picture issues that may not go away very quickly. This bean corn ratio chart, I think, is going to play a massive role in whether we can pull this thing, turn this thing around and pull this market back to the upside, led by the beans, led by the weather. And then the wheat and the outside markets maybe take a break or they don't get any worse. And that's a big if. But we did see Russia raise their interest rates. That's good for stimulating the ruble to see some short covering. We saw the Chinese cut their interest rates. That's good for them to want to be stimulating their economy, which is in a almost deflationary spiral. But getting back to this ratio, Nov beans divided by D's corn just hit a new contract high intraday of about 2.77. We're going to close around 2.75 today. That suggests to me that we're now have stretched that rubber band where the beans are about as expanded in premium to the December corn as we can get them. And so either the beans give up or the beans go higher and the corn follows along with it. Well, what would do that? I think the weather is first and foremost. Obviously, what I really like to see is some recovery in our exports. And so export sales this week are extremely important to me, but it's really in the short term without the demand helping us. It's about this ridge of high pressure and seeing if the Nov 23 beans can't help that D's 23 corn out and get it away from trading so closely with the wheat complex.
Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk as we continue our live coverage from Dakota Fest in Mitchell, South Dakota. Mike, let's go over to the livestock trade and cattle and looking at hogs and cattle together. Kind of a quiet, choppy day scene there, but really this cattle market, we've talked about a kind of a sideways pattern in cattle. We have a cattle on feed report coming up on Friday, and really looking at the demand picture as a whole when it comes to beef production and consumer demand and more. I know there's a lot of things you and I have been covering here in this cattle market. What's the latest you're seeing? Walk us through this chart here and what your thoughts are right now.
Yeah, this is a database that I started over 20 years ago, Jesse. This goes back to 1979, and it shows the commercial beef production, which is the line, the purple line, against the U.S. steer price, U.S. cash price for steers, which is on the left-hand side, but that's the bar. So what we're going into now with this last Labor Day summer grilling holiday quickly approaching and the Packers buying for it by all counts at this point is the end of the positive fundamental seasonal, and we're switching from summer grilling going into the roasting and beef roast and wintertime seasonal. That's always tends to be a little bit of a rocky time period, and so demand's not as strong as it could be going forward here until we get to the holidays. Having said that, the futures market in fat cattle have a discount to them, still trading 179, 180 against that. The cash price probably sitting where you're at, maybe closer to 188, where I'm at, probably closer to 185, 184. Be that as it may, the fat cattle futures market's not a big concern right now to me unless the feeders and the hogs start to unwind themselves. And this chart shows you where USDA came in and they bumped up. They're the blue line on the far right. The blue line shows them adding 465 million pounds of beef production in their report on the WASDE report last week. So that takes you up to a brand new high. And again, that goes back to where you're looking at on the price. You're at a brand new high, but you're also not at the very lowest levels. You're only at about a 7-8 year low on beef production by them increasing it so much. And what they specifically said was, we see higher beef production in 2024 because of higher late 2023 placements and that going into early 2024. So this says to me that if they're going to be right about higher beef production, you're going to see higher placements in the fourth quarter. That higher placements could also come from a drought reestablishing itself in parts of the central U.S., maybe even western U.S. and plains. So that leads me to the conclusion that we're going to probably have a feeder high before we have a fat cattle high with everything that I've said to you today. That's a big deal to me because we peaked in 2014 in the month of October for both fats and feeders. No one put a high in first. I'm leaning very heavily towards the idea that the feeders could put a high in first, and that's what we want to go after for hedges first.
Well, Mike, great thoughts as always here. And before we wrap it up today, any final thoughts? I know there's a lot we're watching, and obviously a nice little recovery in some of the markets on Wednesday. But there's a lot to really take home here, as you've alluded to. So, any final thoughts you'd reiterate to folks to wrap it up today?
What I'm looking at on the grains right now, Jesse, is a protective put mindset, especially for 23 corn. And my risk reward ratio that I want typically in corn is 2-to-1. In other words, if I spend 10 or 12 cents on a corn put, I'd like to get 25 cents or better back on a cash sale that's better. So offsetting that loss in the puts, I think that's where we're at in this market. We need, I think, a floor underneath us if we don't come out of this week, because it really does kind of open up the downside based upon a lot of the things we're looking at. So don't look at it from a standpoint of this is a profitable position from a standpoint of revenue per acre. Look at it as a way to protect and get maybe another 40 to 50 cents down in the corn futures.
Well, Mike, I know folks can find you easily online, GlobalCom with 2Ms, globalcomresearch.com. They can check out a trial, phone call, a lot of great ways to get in touch, isn't there?
Absolutely. And the product services brochure is on there in a PDF file as well. You can see all that we do.
Fantastic. GlobalComResearch.com. Mike Zuzolo, always appreciate your time, sir. Thanks for joining us here. We're going to keep things rolling at Dakota Fest this week, but we appreciate it. We'll talk to you next week.
Thanks, Jesse, and safe travels, buddy.
I appreciate it. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.